Hello, everyone. Welcome. Our presentation today will highlight what we have been able to accomplish this far and why you should invest with Elite Footwear today. We can go ahead and start with our introductions.
Good afternoon. My name is Jesse Sumdahl, and I'm the Chief Executive Officer.
Hello, my name is Brendan, and I'm the Chief Operating Officer.
Hi, I'm Dariel, and I am the President of Innovation.
I'm Yesenia Garcia, and I'm the VP of Marketing.
My name is David Wolf, and I'm the Chief Financial Officer.
Hello, my name is Dogan Ormbatar. I'm the VP of Strategy and Development.
And I'm Kern Hamra, the Chief Administrative Officer.
This is our presentation overview. Today we will be addressing the following topics: our company background, a little bit about us and our goals. Then we will get into Elite Footwear's business strategies, followed by what our production strategies are. We will then touch on our competitive strategies, who our biggest threats were, and how our strategies compared to the competition. Next, we will look into our financial strategies and other strategy changes that we made along the way. And then finally, we'll wrap everything up with our performance summary describing how we finished in year 20. And now I'll pass it on off to Dogan to talk more about Elite Footwear.
Thank you, Yesenia. So at Elite Footwear, our mission is to be best footwear brand in the world. We are driven by our mission every day to work relentlessly and innovate by taking bold and smart risks. Our purpose is to bring health and happiness to our people, our planet, and our community. We do this by empowering and investing in our team, by creating our product more sustainably, and making positive impact in our communities. We work ethically and efficiently to perfect our performance by investing in our best practice training and corporate social responsibility and limiting our footprint by reducing our reject rates. These values directly affect our business strategies. And in the earlier years, we employ broad differentiation strategy by offering by far the most models available compared to our competitions, and raise our SKU rating to mid to high 8 stars. We also choose premium pricing to generate high quality shoes for high price. To better align our brand reputation and drive demand for premium shoes, we heavily invested in brand advertising and celebrity appeals, as it directly increased our demand and market share in both internet and wholesale segments. We also stay strong players in private label segment with at or around 20% market shares while maintaining competitive price and SKU rating. As the years passed, our competition started copycat our strategies, thus prompting us to change accordingly. So we turned our focus to cost management in order to have a competitive price for the same quality shoes. We were able to significantly lower our production costs and reject rates while maintaining our high quality shoes. Thus, we were able to lower our retail price by 10% for both internet and wholesale segment. Next, I'll pass it on to Brendan.
Production strategy from the beginning of the game was that we would begin by selling our North American plant while it was still profitable. This enabled us to begin purchasing new equipment in Asian and Latin American markets. As time went on, we gradually increased our production equipment to meet our growing demand in these markets. Our main production driving factor was definitely the demand created from our Six Sigma and best practices investments early on. This, along with our retail support generated from the celebrities, made a killer combination. The shoe type we were aiming for was a more high-end shoe. In order to meet this high-end goal, we invested heavily in Six Sigma and best practices, allowing us to set ourselves apart early in the years. Wholesale was where we focused most of our price precedence on to meet the growing demand of the shoes, followed by internet, and last but not least was the private. I will now pass it off to Dario to go over our competitive strategy.
Initially, we were aligned with Company G. This changed quickly, though. As my teammate said, the other companies began to copy us. So by the end of the competition, the graphs were in a similar position. Initially, company C was our biggest rival, but they went down at the middle of the game, and then Team J emerged as our main rival up to the end of the game. But in our competitive efforts, one of the things that really set us apart was our strategic use of celebrities to drive our demand incredibly high by focusing on specific markets. And now I'll pass it to Jesse with the finance strategies.
Thank you, Dario. Our revenues have steadily increased through year 16 thanks to our cost-cutting strategy and steady increase in demand. We did have a slight decrease in revenues, as you can see in year 17, due to our celebrity contracts coming to term and a more competitive industry, but Elite Footwear came back strong, setting a new record in revenues for year 20. In regards to earnings per share, our weighted average EPS is higher than any other company. This is a byproduct of our cost reduction and high demand, creating excess of revenues early on. As we bought stock back, the decrease in available shares also made it easy to almost double our EPS as opposed to our closest competitors. Moving on to stock and dividends. From the beginning, it was our strategy to take the initiative and request a number of large loans to buy our company's stock and invest back into ourselves, spanning from years 12 to 15. We let our stock price hover for a few years so we could focus on paying back our initial loans. By year 18, our debt was more than under control. We were able to finish the last 3 years strong by buying back large amounts of stock while issuing a healthy dividend that grew year over year. We were able to finish at the front of the pack with the highest stock price in the industry. Buying stock back also shrank our ending equity, which helped keep our return on equity remarkably high until we stopped buying back stock. We were the only company in the industry to have 3 straight years of an ROE above 120. With a 10-year average ROE of 57.5, no other company was able to keep up. Our strategy to borrow large amounts of money to pull away from the industry and capture economies of scale was a bold move, but it did come with a cost. Years 14 and 15 were especially bad in terms of companies' credit rating, hitting a historic low of a C. However, once we started to pay those loans off, that quickly changed. Last year, we ended with the best balance sheet in the industry, awarding us an A+ credit rating. Last but not least, we are proud to have maintained a perfect image rating of 100 for the last decade, thanks to our high SQ ratings and initiatives to help our community. I will now pass it off to David to go over our strategy changes.
Thanks. So we produced a high quality shoe and maximized our production capability consistently throughout the last 10 years due to factors like high wages for both team members and supervisor staff, as well as having good money invested into Six Sigma and best practices. As I stated, this allowed our team to consistently produce a high quality shoe with an 8.9 star rating while simultaneously keeping production costs low. Our cost per SQ star was among the lowest in the industry for nearly all of the last 10 years. Due to our production costs being so low, we were able to switch to a cost leadership strategy that allowed us to lower our prices and therefore increase our demand for our product. As we stated earlier, we started out with a broad differentiation strategy by having the most shoe models available. But as the competition started to replicate our strategy, a switch was necessary to keep us ahead. This switch to a cost leadership strategy was imperative in year 18 when we lost our celebrity endorsements. Due to these losses, our demand was projected to take a sharp drop, but we were able to weather the storm and bounce back due to our incredibly high shoe quality and incredibly low-cost shoe. I'm now going to pass it off to Curran for the performance review.
So for our performance summary, at the very end of year 20, our stock price was at $557.35. Our ROE was at 42.8%, and our earnings per share was at $23.21. We ended with the highest possible credit rating of an A+, alongside the highest possible image rating of 100. We earned a fair amount of awards in our time with the company, most notably having the #1 ROE worldwide for weeks 14 and 16. We also ended with the joint best overall score of 110 worldwide. We also had 2 more criterias in the BSG Global 100. We already talked about how we were #1 in the world in overall score. Our earnings per share and stock price was also on that list. And we included an image at the bottom of the screen so you could see the impact that we made throughout 10 years of the company when we were with the company. And I'll go ahead and let Dariel conclude our presentation.
So in the end, we have that the star rating, it's incredibly important because even if the shoes are cheap, if they are not good enough, no low price is going to justify any demand for them. We also learned that it pays off to take risks, especially if you take them early on. Us taking big loans and being able to use them to improve our facilities is one of the main reasons for which we perform so well. And you can achieve a reduced shareholder equity to then capture a high return on equity. And thank you very much. That's going to be our presentation for this project. If you have any questions, please feel free to ask us. Have a wonderful night.